Imagine telling your investors that your core business just shrank by nearly 3%.
Right, which usually means panic.
Exactly. And then watching them confidently nod and just, buy more of your stock.
Yeah, it's definitely a weird dynamic to wrap your head around.
It really is. So welcome to this custom-tailored deep dive.
Yeah.
Our mission today is to, well, look at a brand new primary source that just dropped today, May 1st, 2026.
Yep, the Q1 2026 earnings report for Gates Industrial.
Right, and we are using this report as a sort of diagnostic tool for the global industrial economy. Because, if you really want to understand the health of the manufacturing sector, you can't just read the macroeconomic headlines.
No, you really can't. You have to look at the companies that are actually supplying the invisible arteries of the physical world.
I like that, invisible arteries. So for those listening who might not know the name, Gates makes these highly engineered power transmission belts, fluid power hoses, hydraulic components.
Basically the stuff that keeps agriculture, heavy construction, and energy production moving.
Yeah, literally moving, like everyday consumer items too, right? Printers, vacuums, power washers.
Oh, yeah, absolutely, everywhere. And because their products are embedded in the capital equipment of almost every heavy industry, their quarterly performance acts as this incredibly sensitive barometer for global industrial demand.
So it's like taking the blood pressure of the global economy.
That's a great way to put it, yeah. Because when their volume drops, it means fewer excavators are being built, fewer agricultural combines are rolling off the assembly line.
Right. The broader capital expenditure cycle is basically tapping the brakes.
Exactly.
Which makes this Q1 report we are looking at an absolutely fascinating study in contradictions. Because right now, Gates is giving us some very mixed signals.
Very mixed. On the surface, the top-line numbers show a business that is growing.
Right. So net sales came in at $851.1 million, which is technically a 0.4% increase over the exact same period last year.
Right, which was $847.6 million.
Yeah. But the moment you look past the headline revenue, the narrative just kind of fractures.
It does.
So, okay, let's unpack this. The report immediately introduces this secondary metric called core revenue. And that core revenue actually contracted by 2.9%.
Right, almost 3%.
Yeah, so we're looking at a scenario where a company is pulling in more total dollars, but the organic machinery of the business is actively slowing down.
What's fascinating here is how the sheer scale of a multinational footprint creates these massive distortions on an income statement.
Because they're everywhere, right?
Exactly. Gates operates across more than 130 countries. So their revenue is this chaotic blend of euros, yen, pesos, dozens of other currencies.
Oh, right, and they all have to be translated back into U.S. dollars for this filing.
Precisely. So net sales simply represents the raw pile of cash at the end of the quarter. But core sales, that's the structural reality.
Gotcha.
It strips out the noise of currency exchange fluctuations and, the artificial growth from any recent acquisitions.
I think about it a bit like sailing. Like, net sales is the absolute speed your boat is traveling across the water. But core sales subtracts the currency tailwind or headwind to show you how hard the crew is actually rowing.
Oh, that's a perfect analogy.
And right now, the crew is rowing about 3% slower than they were a year ago.
Yeah, they really are. And the report quantifies this currency distortion beautifully. There is a $27.9 million negative impact strictly from foreign exchange movements.
Like almost $28 million just from currency?
Yep. So the strong dollar is basically masking the underlying contraction in their global volumes. The broader industrial slowdown is clearly suppressing their organic volume.
Because of interest rates and stuff.
Exactly. We are seeing a cooling off in the capital-intensive sectors they supply. High interest rates over the last couple of years have inevitably delayed heavy equipment purchases.
Right, like in agriculture and construction.
Right. When the financing cost for a whole new fleet of tractors stays elevated, the original equipment manufacturers slow down production.
And so the orders for Gates's hydraulic hoses slow down right alongside them.
Exactly. It's a direct chain reaction.
So the core business is undeniably shrinking. But, that brings us to the central mystery of this earnings report.
The panic or lack thereof.
Yeah. If core sales drop by nearly 3%, why does the tone from the executive suite, particularly from their CEO Ivo Juripic, sound so profoundly calm?
Well, to figure that out, we have to look beneath the hood at how they're managing their operations.
Right, because if we dig into the segment performance, the contraction is incredibly broad. I mean, the power transmission segment brought in 533.2 million, but saw a 2.5% core decline.
And fluid power took an even harder hit.
Yeah, 317.9 million in net sales, but down 3.5% on a core basis. So volume is literally falling across the entire house.
It is. But the calmness you're picking up on, that comes from their absolute, almost ruthless defense of their profit margins. Yeah, a business can weather a top-line contraction if their operational discipline is tight enough. They just have to compress costs at the exact same rate that revenue is falling.
And did they?
They did. Despite the core shrinkage in both divisions, Gates posted an adjusted EBITDA of $177.4 million.
Adjusted EBITDA, so earnings before interest, taxes, depreciation, and amortization.
Right, exactly.
Which translates to an adjusted EBITDA margin of 20.8%.
Which is incredibly solid given the volume drop.
Yeah, I mean, they only gave up about 130 basis points from their 22.1% margin the previous year.
Right.
Holding a nearly 21% profit margin while your actual sales volume is deteriorating. I mean, that is a massive testament to their internal levers.
They really aren't just sitting back waiting for a macro recovery. They are aggressively managing the cost of goods sold. And, oh man, we can actually see the granular mechanics of that cost management in their accounting adjustment.
Oh boy, here we go into the accounting weeds.
No, wait, it's actually super cool. If you look at the reconciliation tables for their adjusted gross profit, they explicitly highlight a $4 million inventory adjustment based on LIFO accounting.
LIFO, last in, first out.
Yes, last and first out. In an environment where the costs of raw materials and inputs are highly volatile, utilizing LIFO is basically a structural defense mechanism.
Because it matches your most recent, highest production costs against current revenues.
Exactly. So by reversing that $4 million adjustment to calculate their adjusted metrics, it shows investors the true underlying profitability of their operations.
Oh, I see.
Right. It isolates their manufacturing efficiency from all the inflationary noise happening in their raw material supply chain.
Okay, I will stop laughing at your excitement over LIFO, because that is actually a really clever way to protect margins. And for you listening, why should you care about this accounting trick?
Yeah, it sounds dry, but it's huge.
Because that level of visibility into their cost structure is what allows them to execute major internal overhauls without destroying the quarter.
Absolutely.
Like, Ivo Jurek specifically highlighted the successful implementation of a new enterprise resource planning system, an ERP, in Europe during Q1.
Which is a notoriously dangerous operational maneuver.
Oh yeah. Normally, an ERP upgrade during a quarter with contracting volume is an automatic excuse for an earnings miss.
Oh, 100%. Companies always blame the software migration for shipping delays, lost invoices, ballooning overhead costs.
Right. But the fact that Gates pulled off a major European IT infrastructure upgrade while defending a 21% EBITDA margin, that tells us their operational controls are incredibly rigid.
They completely absorb the friction of a massive systems migration without letting it bleed into their operating costs or, disrupt their fulfillment to the point of margin compression.
It's basically a signal to the market that their internal efficiency is highly resilient, even when the macro environment is totally uncooperative.
Definitely.
But, okay, here's where it gets really interesting. Profit margins and adjusted EBITDA, they're great, but they are ultimately accounting constructs.
Right. You can't pay your employees with adjusted EBITDA.
Exactly. They tell us about operational efficiency, but they don't pay down debt or fund capital expenditures. To understand the true velocity of this business, we have to follow the cash.
The physical money entering and leaving the building.
Right. We have to look at the cash flow statement. And this is where the narrative of a sluggish Q1 completely inverts.
It really does. Net cash provided by operating activities jumped massively.
Yeah, from a meager $7.3 million in Q1 of last year to an impressive $30.2 million this quarter.
That is a staggering acceleration in cash generation against the backdrop of lower core sales.
Wait, so sales drop, but cash goes up by over 4 times.
Yeah. It proves they are squeezing working capital out of the balance sheet. They are collecting receivables faster, managing their payables more aggressively.
And preventing capital from getting trapped in slow-moving inventory.
Exactly.
And it leaves them sitting on just a fortress of a balance sheet with $785.3 million in cash.
And they're deploying that capital with a lot of confidence, too.
Oh, big time. we see $16.6 million spent on share repurchases.
Which means they're retiring equity at a moment when the market might be mispricing their future growth based on that Q1 contraction.
And simultaneously, they pushed $16.7 million into property, plant, and equipment.
Investing in the physical capacity to expand their manufacturing footprint.
So they are playing offense with their balance sheet while playing defense with their income statement.
That's exactly right. And if we connect this to the bigger picture, the confidence to buy back stock and invest in capacity stems from a single forward-looking metric that management emphasized.
The book-to-bill ratio.
Yes. Ivo Jurek noted they exited the quarter with solid order rates and a book-to-bill ratio comfortably above 1.
Now, we don't need to completely rehash the mechanics of book-to-bill for this audience, but a ratio above 1 means Gates is receiving more new orders, the book, than they are currently shipping and billing for.
Right. It is the ultimate leading indicator of future revenue growth. And the implication of that ratio sitting above 1 right now is basically the key to the entire report.
Because it bridges the gap between a sluggish Q1 and future optimism.
Exactly. It confirms that the 3% core contraction we saw in Q1 is purely a lagging indicator.
The backlog is swelling.
Yeah.
The orders coming in the door are outpacing the products they're currently invoicing and shipping out.
The revenue simply hasn't been recognized on the income statement yet, but the contracts are signed and the demand is totally secured.
Which fundamentally changes how we have to interpret the Q1 results. The volume contraction isn't a symptom of evaporating demand.
No, not at all. It's just a reflection of the timing of shipments and, the lingering effects of the previous quarter's industrial slowdown.
So the heavy equipment manufacturers are beginning to restock and reorder.
That's what the robust book-to-bill ratio indicates.
Okay, so what does this all mean? We need a reality check on their 2026 guidance.
Yeah, because armed with that swelling backlog and surging cash flow, management is making an incredibly bold bet on the rest of 2026.
They are reiterating their full-year guidance, projecting 1% to 4% core sales growth, and adjusted EBITDA between $775 million and $835 million.
And free cash flow conversion exceeding 90%.
I just have to challenge the math here, though. How on earth do you look at a 2.9% contraction in Q1 and confidently project up to 4% core growth for the year?
It's a steep climb.
To hit the midpoint of that guidance, the math demands a massive, almost reckless acceleration in the second half of the year.
Right, and this raises an important question about the phasing of the industrial cycle. By reiterating that guidance, Gates is implicitly forecasting a huge hockey stick recovery in the back half of 2026.
They are betting that the orders currently sitting in their backlog will just translate into rapid high-volume shipping as the year progresses.
They are. They're basically assuming the broader capital expenditure cycle in agriculture, construction, and energy is hitting its absolute trough right now and will aggressively rebound.
But, and this is a big but, the forward-looking risk factors included in this report outline a very perilous path to that second-half acceleration.
Oh, yeah. There are some major macro risks standing in their way.
Right. I mean, you cannot project a global volume surge without flawless execution in the supply chain, and the geopolitical weather is incredibly hostile right now.
Unbelievably hostile.
The report explicitly highlights the ongoing conflicts in the Middle East. And, to be clear, this isn't abstract political commentary from them. They view it as a direct operational threat to their logistics.
Yeah, it impacts supply chains directly. Because when global shipping is forced to reroute around the Red Sea and the Suez Canal to avoid conflict zones, ocean transit times stretch by weeks.
And freight rates spike exponentially.
Right. And suddenly, that perfectly calibrated European ERP system we talked about earlier, it's starved for raw materials that are stuck somewhere off the Cape of Good Hope.
Wow, yeah. The margin compression from elevated freight costs is a severe threat to that $835 million EBITDA target.
It really is. And furthermore, the report calls out the looming risk of potential U.S. tariffs.
Again, just impartially reporting what's in the document here. As a manufacturer deeply reliant on global supply chains for raw materials and component parts, the sudden imposition of tariffs acts as an immediate tax on their cost of goods sold.
Exactly. If they cannot pass those tariff-driven price increases down to their channel partners quickly enough, that pristine 21% profit margin will erode rapidly.
Which brings us to the final and perhaps most volatile risk variable in their projection: the unpredictable inventory levels of their key channel partners.
This is such a huge factor. Gates relies on a massive global network of distributors to push their products into the end market.
Right, so their ability to realize that hockey stick growth in the second half relies entirely on those distributors having the capital and the confidence to stock up on Gates inventory.
And if those distributors face tighter credit conditions or, if they misread the demand signals from their own customers, they will aggressively destock their warehouses.
Basically killing the order flow back to Gates, regardless of how strong the end user demand might actually be.
Exactly. The middlemen have all the power in that dynamic.
Right. So to bring this all together and succinctly summarize this deep dive, Gates Industrial had a sluggish Q1 2026 on paper, with core sales shrinking.
Right, nearly 3%.
Yet, through operational discipline, strong cash flow, and a growing backlog of orders, they are confidently betting on a strong finish to 2026.
Even though global supply chain shadows and macro risks still loom large.
They really do. But they've built a financial fortress capable of withstanding the current industrial trough.
Yeah, positioning themselves to capture tremendous operating leverage the moment the macroeconomic winds finally shift back in their favor.
As we wrap up, I want to leave you with a provocative thought to chew on regarding that final risk factor we discussed. The concept of channel partner inventory levels.
Yeah, that passing phrase in the risk factors is actually profound.
It really is. In the world of industrial manufacturing, this is the bullwhip effect in its purest form. Because Gates creates these essential, highly engineered components. But no matter how good their products are, their financial success is completely at the mercy of how crowded the warehouse shelves are at the companies that buy from them.
Right, the shadow inventory distributed across thousands of independent warehouses globally.
Exactly. Think about the collective psychology of those warehouse managers. If they feel even a slight chill in the economy, they halt orders and bleed down the inventory they already have on the shelf.
And Gates experiences that as a violent drop in sales, even if the end users, like the farmers and construction crews, are still burning through belts and hoses at the exact same rate.
Conversely, if those warehouse managers anticipate a spike in freight costs or a shortage of materials, they panic order, creating an artificial boom in Gates' backlog.
The boom and bust cycles of the entire manufacturing economy are driven not just by physical reality, but by the anxiety and optimism of the middlemen managing the shelves.
That invisible shadow inventory dictates everything. And according to Gates, that shadow inventory is currently crying out for replenishment, setting the stage for a powerful second half.
It's going to be fascinating to see if they can execute on it.
It really is. Thank you for joining us on this deep dive. Keep questioning the consensus, always look beneath the top-line revenue, and keep exploring.